This is Smart Investing with Mike.wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike.wren.
Well, hello, everybody. Thank you once again for bringing up another episode of the Smart Investing Show, where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, we try to get you good, relevant information on each and every shoe. And thirdly, and I think probably the most important part of the show when it comes to listening to it every week, is the entertaining part. So it feels like you're not that you don't have to do it. We try to, a little bit of a spoonful of sugar with your medicine, so to speak. I think the investment industry could use some levity, some entertainment.
Yes,
so
you make me listen to these guys and see how that they're the drolliest.
Yeah.
I might as well have some man read me a bedtime story.
They make our worst day sound like we're on some sort of upper drug. Yeah, our worst day. When we think that we're sucking, we're still above the other people in our industry. We're not talking entertainment. We're talking investment industry.
And I remember people were like, well, you guys can't be that smart because you're funny.
Actually, it's the other way around. Usually the intelligent people, not saying that we're part of that, intelligent or entertaining. I'm just saying that usually the entertaining people have enough extra horsepower in the thinking category that they can take the information in quick enough, understand it, and then be communicating it in kind of a fun way. Imagine that. Yeah.
Almost like the teacher that you liked.
Almost. So I forgot to say your name, actually. This is Selfie Dad, Mr. Chris Martin, my producer. That's why we're entertaining. So good morning, Chris.
Morning. How you doing?
How's it feel? I was talking to somebody in the office, not a client, but somebody from my industry, and he was saying, what I did. And they usually when people ask me how I run my practice, and I tell them, you could knock them over with a feather because it's not like the rest of the industry. That's a little bit of what the show is going to be about. Then I said, the reason that the podcast is decent is because of my producer, Chris. It's not me. And I said, are you on social media a lot? And if it's somebody younger than me, they usually say yes.
Yeah, I've noticed there's a different demographic.
Okay, Chris now is using a car key to fix his laptop.
I hear a little hum that was bothering me.
That's my new Iron Man pacemaker thing.
Yeah, no, you don't have a heart for that.
Anyway, I described you to him. He remembers singing you in several different spots and thought it was awesome.
Oh, yeah.
Yeah, any sort of fame that you got, you deserved double of the amount because people really identified with you. I
remember when Ralph Garman and Kevin Smith, two guys that are kind of famous for doing voice work and directing. They were in Spokane, and they were like, "Oh, Selfie Dad's here. You were red hot for a minute." And I was like, "That pretty much explains."
I would say you were red hot for 10 minutes.
I strangled the 15 minutes of death and then brought it back to life. I will tell you, the other night, my daughter's on another app that, like Instagram, Twitter. There's a new one called TikTok, and she was on it.
Sounds like a bomb that's going to go off.
She's got like 100,000 followers, and they're all like, "Your dad's not Selfie Dad." So she had to bring the phone up and live tweet basically of TikTok, and "This is my dad. That doesn't look like him." So,
you're kidding me, really?
I had to stand next to a photo like I'd been kidnapped. Yeah, it's me. Just been a couple years.
God, Chris.
I'm not shaven.
Jesus. Let me tell you, listeners, Chris has explained 1/100th of what he's gone through with that. You have thick skin. Any sort of an ego that you had before you started this,
it has to be gone.
No, not gone, but what you have left has got to be unassailable. It's the Rasputin ego. You know what I mean? Whatever's left. If it was me, I don't know how I would have reacted to that. I mean, come on.
You can't fight on the internet. those are mouth breathers. You can't fight it. So when people insult me or something like that,
mouth breather. A lot of us might be
knuckle dragger.
No. A lot of us might admit to that occasionally. Maybe if we're sleeping. Window licker. There you go. That is the one that I would use. It's more poignant.
The only real right.
It's the 60 minutes of put downs instead of.
I could be roasted. I'd be one of those people that gets roasted and laughs now. Before I would cry. Now I'm just like whatever.
Yeah. You have skin as thick. I happen to know you have skin as thick as if you were a Mormon missionary, where you would have spent a couple years in your very early adulthood getting people to tell you no in various ways and with various digits.
Door shuts in my face. I'm like, thank you for listening.
That's.
I feel like I should say though.
I wonder if you could find a sound break.
Door shutting.
Yeah, and somebody saying thank you for listening.
Thank you for listening. Smart investing. Boom. Thank you for listening.
Hey, have you ever heard of Amway? Boom.
Have you heard the word of Mike.wren? Slam.
Very good.
I should say that it wasn't all like rosy. I mean, my daughter spent the first 2-3 days crying because people were so mean to her. So I had to come out because people are dumb. People want sides. And so everybody was on my side. Yeah, you really stuck it to that teenager. Ha, ha, ha.
When you said sides, I'm thinking of restaurant sides. Yes, I'll take corn and mashed potatoes.
Eat breakfast today?
No, not yet.
Okay.
That's where my mind went. Side. How many do I get? 2 or 3?
Do I look like a chicken leg right now talking?
Kind of.
Did I change?
Okay, everybody. We might want to try to talk about investing just a little bit.
Sure.
Especially because we haven't been on the air for a couple weeks on the air. We haven't released any new content for 2 weeks. And truly, it was out of our control. The first one of the weeks, it's because Chris's normal job that people treat him normally. They don't berate him like I do. He had to work extra.
There is nothing worse than working 6 days and you get 1 day off. So you spend that whole day going, I can't believe I got to go to work tomorrow.
Oh, you're right. And then the next weekend, we'll just say that there was, family medical stuff on my part, not my medical, but it was serious enough that it, blew apart the weekend. So now here we are 2 weeks later. So we apologize, or I apologize.
We fought our way back tooth and nail to bring this podcast to you.
Yeah.
You're welcome.
So anyway, today's podcast, I wanted to try to talk about a couple things in an interesting, not get too serious, but make sure that you knew that they were serious topics. I've talked with a whole bunch of people in my industry, which is always a downer. Yeah, and make sure that you realize that when I say downer, I really mean downer when I'm talking to people in the industry. So they like to say that the way that I run my practice is this or that and blah, 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 blah. So what I wanted to try to talk about in a pretty good way is, one, why I'm having to justify the way that I do things to my industry, to different peers in my industry. And the other reason is to try to reassure you, the client, why it is that I do what it is. Why have I made the decision why have I chosen to do this? Because literally with the internet and all of the media outlets nowadays, you have all the people in the world telling you kind of that there's basically one way to make the money, and that's to just invest in an index fund. And I have people in my own industry doing that. And now that you've had the market go up slowly for 10, 11 years, and yeah, it's gone up slowly. I don't really know what the cause of it is. Of course, I would like to blame any sort of left-wing principles of business on it, but I haven't taken the time to gather the empirical data so I can say this is what caused it.
I'd like to personally blame Gwyneth Paltrow.
Exactly. So anyway, when you have a stock market that's gone up, albeit slowly, for more than a decade, you're going to have people come out of the woodwork to start to say things here and there. So that say, oh, well, things are different this time, and on and on and on. So let's start with, why do I do the things, why do I behave the way that I do? Yeah.
This is only a 45-minute podcast.
Exactly. Why do I invest the way that I invest for clients? Why do I tell them to do so? Why do I fight so staunchly for it? Okay. And we could compare this to somebody that was a personal trainer or anybody that's in charge with helping you complete a task or reach a goal. In my opinion, I'm trying to get you to the goal the most sure way possible. Doesn't that make sense? Isn't that what you would want somebody to? I mean, there's
kind of the coach's job.
Yeah, and we got to get to the championship the most sure way possible. There are other coaches out there that say that we can get to the goal, I guess, in a softer way, in a way that's less stressful, I guess. You know?
But you're the coach that says, you know what? I know you think little Timmy's a regular good guy, but no, little Timmy's a snowflake and he's got to sit out because we're trying to win this game.
Yeah, there's just a whole bunch of ways. There's just a whole bunch of reasons why, and I don't want to go into them because I'm going to get to some of the reasons no matter what. But the reason is I feel that when somebody hires me, I feel that they're hiring me to get things done the most sure way possible. And that should account for something. Why do I think it's the most sure way? Why do I do that? Well, or what is the most sure way? Let's start with that. I think that you, the client, want to grow your investments. Typically, this is very typical. Most people, all of my clients, well, not all anymore, but the vast majority are refugees. They came from someplace else. They were working with someplace else. Someone else. They had some different strategy. Maybe that they were doing it on their own and they finally needed help, something or other. They were investors before they came to see me. And so I have never held my shingle out as some planner to help you make a budget or to do this or to do some version of a Dave Ramsey thing, because number one, that isn't me. And number two, like I've said for years, where the Dave Ramsey show starts is where my show begins. I mean, where the Dave Ramsey show stops, that's where my show begins. They really don't overlap at all. You can overlap them if you want to make one big, oh my God, long show, but they don't overlap.
If you want to watch these two fight at the end.
No, not fight. It's just that his show does one thing, my show does another. That's just the way it is.
Different coaching styles.
Well, no, he's telling people to pay off their debt. It's like, if you don't really know that, I don't want you in my office. It's like, you know, that's beginning level stuff. And it's good stuff. Just because it's beginning level doesn't mean that it's bad. It's awesome stuff. But I don't go there because there's not enough hours in the day. I need to be a little bit more specialized. So I feel that when people come to me, they've been someplace else. They've want to change. And by the way, the vast majority, none of my day is spent getting new clients. So there's no marketing at all. This podcast that I'm doing is only going to people that either by some stroke of luck find this podcast or they already know about Chris and I. Okay, that's it. That's only where so the listenership of this podcast, while it's growing, albeit it's growing slowly because we're not advertising ourselves in print or social media or internet media out there. This is just, it is what it is. So when people are seeking me out, I'm thinking that they want two things: growth of their investments, which I term principal, growth of their income, which doesn't need a further explanation. Usually folks that are still working, they don't need income from their investments. When they decide to not work or work less, usually they want income from their investments. So that's what I think that I should do, is they need growth of investments and growth of income to meet their life goals. Because it'd be nice if a person didn't always have to focus on money. They could just focus on life and realize that the growth of their wealth over time was going to take care of things. That's what I try to do. I usually try to use the simplest plan. The simplest plan I happen to believe is usually the best plan. Why? Well, I think it's self-explanatory. The simplest plan is going to have the least confusion for the person that's not as experienced as me. Number two, if it's easy to understand, it's going to be easy for me, the professional, and easy for the client, that's not a professional, to come to some agreement, to behave the same, to kind of think the same, to be on the same page, to realize that we both understand the goal and I understand the path, and after we've been on the path a few years, the client understands the path then. So the simplest plan, also, I think, since it has the fewest moving parts, it's the most economical. The most economical tends to be the most efficient. And when you've got economic efficiency, you're good. Typically, you've got good performance and you don't have a lot of drag. There isn't a lot of commentary to muddy the waters. And also, I cut right to the chase. I realize that while security selection is incredibly important, you, the investor, your behavior, that's where the rubber meets the road. If something's going to go wrong, it's not going to be a big thing that's going to go wrong is the client's behavior. It's not going to be me making a mistake with a company like a General Electric that doesn't do what I want it to do because it's just one company in a portfolio. So while obviously it's not something that I want to have happen, it's going to happen. If we are on the Oregon Trail coming out to be settlers, not every river crossing is going to go well. We'll probably cross the river at one point and be, moseying along for an hour or two, and then all of a sudden we happen to see a nicer river crossing. That's called hindsight. And then everybody in the covered wagon looks at you, and as long as you live the next 10 minutes and they don't kill you, everything's good. It's a pretty good analogy for investing. So, yeah, if I can get you, the client, to behave properly, in other words, where you don't panic out of investments and you don't panic into them. Panicking out of them, obviously when the market's going down. Panicking into them, the fear of losing out. So it's basically both fear-driven. The fear of losing and the fear of losing out causes most people to do the wrong thing at the perfect time to really screw themselves.
I think that's something we haven't really talked about a lot, is people panicking in. I mean, we talk a lot about people panicking out, but you don't talk about it, people that just, I got to get more of this.
And you only get that after an investment, after a thing has gone up in value for so long a time that's like, well, I better get that too before it continues to go up. That's the fear of losing out. And I think some of that's happening in the real estate environment right now.
Well, you also get a lot of grass is greener, though, don't you? Like, Steve from work is invested in this. And
yeah, but you need positive markets to do that. That's when your fear of losing out. The fear of losing is when Steve is also telling you at the water cooler that he sold everything 6 months ago because he, quote unquote, knew that this was going to happen. And we all know how much bullshit that is. You can cut it with a knife. It's so thick. So,
really? Because I got a gypsy woman on retainer that she tells me I know what's going to happen next year.
We'd like to apologize to all the gypsies out there. Come on, Chris. You would just...
She's the one that told me I'm going to die by a man who's left-handed with only 3 fingers, and I believe her.
So he's a former fireworks technician then.
Yes.
Yeah, okay. So simplest plan, if I spend most of my time on the psychology. My industry is just now getting there, okay? My industry is in the infancy of behavioral science. I don't know why it is, because anybody that has two brain cells to rub together knows that human beings are irrational. So you have to tend to that irrationality the very first thing. So again, if I can get you to behave properly, then we don't have to own any sort of investment product that is sold as helping you behave properly. Helping you behave properly, maybe by saying that you can't get your money out even if you wanted it. Maybe it's supposedly going to help you because it offers less volatility. And of course, my industry isn't going to say it in those words. They're going to say it's quote unquote safer. Safe this, more risky that. They haven't a clue of what those terms mean. So, yeah, if I can get the client to behave and not panic, then we're good to go. And a lot of times, how I do that is just being very real and describing that I realize that most of the people in the world, let alone the United States, should not be investors. They're not emotionally capable, and they might not even have enough money to do so. They're trying to double their money in 6 minutes on one hand, yet they're paying 15% per year interest on a credit card with another. It obviously always works to pay off debt. It always works. It's always good advice. It's good for a person. It's good for a company. And it's so elementary that I'll leave it to Dave Ramsey to tell people. I don't need to tell people that. I will occasionally come into that. One of the last clients that happened to become a client of mine, they had some credit card debt. They were about ready to retire. So I said, why don't you take just a little bit extra out and just knock out that credit card debt? And they said, well, that we were going to ask that and all that. So it was simple. It wasn't a huge amount of money. You know what I mean? Doing it, believe it or not, I get thanked very little with what I do. And this is one of the emails that came in where the wife was saying, I can't believe how good it feels to have that paid off and da-da-da-da-da-da-da. So, yeah, just because the Dave Ramsey stuff is so simple doesn't mean that it isn't powerful. So it's just that I don't go there. That's what he does. And what I do isn't based on marketing. It's based on pretty much performance and just, logic. So
in fact, I think the last Dave Ramsey show, he was like, I don't do what Mike does.
Oh, yeah.
I'm pretty sure I heard that.
You're pretty funny, Chris.
Pretty sure.
So anyway, hopefully the podcast is actually sounding good today because I'm going to tell a little backstory here where our computer has stopped twice. So we've had to replay the show and then bring it back up. So if it sounds like I've been a little bit disjointed, it might not be me this time. It might not be the coffee. It might be the computer. So I'm just saying that.
I'll smooth it out. I'm a genius.
Okay. So, yeah, I like the most sure path. I want to grow your principal. I want to grow your income. Usually the simplest plan is the best. Usually the client's behavior is the weakest link. And there you go. So when you know all those truisms, the reason that I invest in individual companies is many different reasons. Number one, it's the most efficient way because when you're dealing with money, you want as few costs, you want as few bites of the pie going down the line so the client gets the most of the returns. And getting most of the returns, it's kind of nice if you have good returns to begin with. So to make this show compliance friendly, I'm not going to tell you the types of returns. You can look them up yourself. I would suggest to you to go to Yahoo Finance or Google Finance and on a piece of paper write down 10 of the companies that you like the most. And you could actually even write down 20. And if you are listening to the show, you probably know which ones are publicly traded. And it could be like Boeing or Nike or Walmart or, Procter & Gamble, Johnson & Johnson. And again, these are not solicitations to buy or sell. It's an example. Plug those names into the computer and then hit historical data and look and see what the prices of these things were 10 and 20 years ago. I think that's going to be very instructive. And then put in the index, the S&P 500 index, see what it is today, and then plug what it was 10 and 20 years ago, and see which one outperforms. That's all you're going to have to do. And you're going to say, wow, okay, yeah, these are pretty good companies. Why am I telling you to do that? Well, because you have everybody else telling you not to do that. You've even got Warren Buffett telling you not to do that. He's saying that, his performance is going to be very close to that of the S&P, so maybe you shouldn't even invest with him. Maybe you should just put your money in the S&P. Well, that's pretty nice. He obviously doesn't care about anybody investing with him. And number two, why is that happening? Well, it's called the law of large numbers. Berkshire Hathaway is the largest taxpayer in the United States. It's the largest taxpayer in the United States. It's a pretty big sum of money that he manages. In fact, it's so large now, he has to have so many companies spread around when you're talking that big of a bucket. And again, the law of large numbers, when you have that many companies involved in this economy, you kind of are a big enough of a piece of the S&P 500 that you are the S&P 500. You can't outperform it or be safer than it. So that's why it's happening. It's not because he's bad at what he does. And that's why his advice to you to invest in the S&P 500, I think, is freaking flawed. And it's hypocritical as the day is long. His managers that he's hired, the younger ones, they're going to do better than him because he's evaluating them on a very much smaller bucket of money. And what's nice is us, the people that I'm talking to, you, the listener, you don't have billions upon billions of dollars. We don't have to worry about owning too much stuff. But yet that's what he and everybody else out there wants you to own. The index. It's not 500 companies of equal slices. It's capital weighted, okay? It means the 20 largest companies are going to account for 80% of the returns in the movement. So it's really not that diversified. And in this type of an economy where a company can have very little capital invested and start cranking out money because of the internet, which means they don't need brick and mortar. They can just have people clicking and shipping stuff to them like Amazon versus Walmart. Well, you can see that Amazon is a much, much more efficient user of capital. They don't have to build a store to sell stuff. Neither does Walmart. They can actually ship it too. But do you see there, so Amazon being one of the 20 largest companies, there is a benefit to owning some of those big suckers because they became big because they're eating everybody else's lunch. They're rewriting the rules of how a company works and how profitable a company can be. But they're not rewriting the rules of the universe. There's a difference. So me, when I am telling somebody how I'm going to invest their money, I'm not going to use the indexes because I would like to do better and be a more efficient way. And me just telling you to write down 10 companies that you know or 20 and go back 10 or 20 years, you're going to see the difference in performance. It's right there. Why? Well, because the index is made up of a whole bunch of companies that you would never invest in anyway. So you avoid all of the chaff, you just want the wheat. And thankfully, a lot of these companies, when I think just because of, let me back up, because of human nature, me saying that, I think somebody might make the mental leap where we're going for nothing but home runs. No, we're not. Hitting singles, hitting doubles, just being consistent matters a lot. It matters for actually getting to our goal, and it actually matters too for managing your emotions. So while we know that biotechnology is going to grow over the next 20 years, which means gene therapy, while we know that artificial intelligence is going to grow by leaps and bounds, that computing power is going to grow by leaps and bounds, that communication levels are going to grow by magnitudes because of new 5G. We know that those are going to be the engines of growth that are probably going to upend a lot of businesses and cause them to have troubles. Well, if you own the ones that are doing the upending, you're going to make a lot of money. There can be some stress involved in that because typically you don't win every battle. So if you take some of those companies that are going to have more market share over the next decade or two, and you combine that with a company that you can't ever see going away, like the drive-thru at McDonald's, well, then you are building something that you emotionally might be really, really okay with. And by the way, McDonald's is not a solicitation to buy or sell. It's just me telling you what you're familiar with and what's profitable as well. That is a fact for our compliance people. You look up and see the earnings of what McDonald's has done over the last 10 and 20 years. Let's just say they've earned money.
Have they added an extra drive-through or taken away a drive-through? They've added.
Exactly. So even the McDonald's downtown on 3rd that is got the worst drive-through, but it's pretty efficient, even they're updating it.
Oh, wow.
Yeah, they're updating it. And I even know how much it, let me just tell you, I've got pretty good intelligence. To add a drive-through at a McDonald's, when you factor in all of the costs of the electricians, the contractors, things that one lane is about $200,000.
Eesh.
When you're talking concrete, electronics, just the stuff.
This is just the one you pull around the building, you order, you go ahead. This isn't like that 2-lane freeway on-ramp thing that they got.
Yeah, the second lane, when they do a second lane, it's another couple $100,000.
Jeez.
So if they're putting in a couple $100,000, I guarantee you they're not doing it because they're surely going to lose money. They're doing it because it makes them money. But I digress. That's how come I invest the way that I do. I don't go after the packaged products because many years ago, I built my practice much, much more differently than the people in my industry usually do. And so I built it one client at a time. And when you build things one brick at a time, you become very, very intimate of the workings of a human being and very intimate of the workings of a portfolio. It's not a big Amway sales gig like a lot of my industry treats it. So when I've done it that way, I've kept it that way because when you deal with clients in that manner and I build my practice that way, that is what makes it the Rasputin practice that can't be killed. Where everybody, not everybody, but it's just a really good thing when they start getting the performance and they can see some good news happening. So I bring that up again to recap a little bit because you have everybody in the media just pounding to death this index crap, even Warren Buffett, okay? And it's never ending. It's become out of the ether, it's become the measuring stick, and I don't know how in the hell it got there, but when people just start talking about that, they're talking about the math, and they've lost sight of the fact of what you're doing. You're actually investing in a business. You're not just putting your money into some sort of index bloody lottery that you're hoping to get little bits of. It's so far removed, they haven't a freaking clue of what they're doing anymore. And if you just have a really good business, you're going to, and you run it well, and if it's profitable, you're going to love it. Why do you think people own the smaller ones? Why do you think there's a Zips? Why do you think there's a Cleaners? Why do you think there's a McDonald's or a White Elephant? These local businesses. People own those. They make cash. They love it. Why do you think people own 7-Elevens in the convenience stores? There's business being done there, people. That's where you invest your money. So people concentrate too much on the math. And you have my industry, by the way. I mentioned that it's a downer talking to people from my industry. People in my industry like to, even though they don't have the clients that I have or the performance that I have or the experience, they'll tell me, well, your practice compared to somebody else's practice, if somebody was purchasing a practice, it's probably not worth as much as the next person because the next person is investing their clients' monies in a way that's easily duplicatable. In other words, they're using a model, they're using index funds, they're using an asset allocation model where they treat every client the same. That way, when that investor, stockbroker, investment advisor retires, you can easily insert another person in their chair and they can take over the practice seamlessly. What about that says that you, the client, are happy with that situation and are actually making money? Nothing. It's all focused on themselves. My industry carries a mirror around with it now, kissing itself and giving it pats on the back because it thinks it's so awesome with what they do. that now the industry unwittingly is devaluing me. They're devaluing a critical thinker. They're devaluing anybody else like me. The mutual fund managers, nobody's even talking about mutual fund managers anymore. The good press that mutual fund managers, that good money managers get is seriously declining, and Warren Buffett is one of them. And now he's even, become maybe not enough with the times. Maybe he's finally, I'll say it, gotten too old, and gotten too big. I don't know what the deal is, but there are a few people out there that really know how to manage money well, and the whole world isn't even paying attention to them anymore because they're not an index, or they're not, quote unquote, running a money management firm that's easily duplicatable.
You're describing an invasion of the body snatcher scenario. That's
Yeah,
what you're doing.
Well, investing.
They point at people like you and go, whoa.
Yeah, we're not selling hamburgers to the masses. Investing is much, much more psychological. And if it's psychological, we're all kind of wired the same, but still there has to be some individuality in there. That individuality is where the genius is. So when I'm talking to the downers in my industry and they're looking at me like I have 2 heads, 5 heads, the reason I'm okay with it is I'm dealing with my clients, and my clients are giving me the hugs and the thumbs up. That's all I need. I don't need a pat on the back from people that are less experienced than me. In fact, I care more about the color of toilet paper I buy than those people's opinions. So anyway, I think that's a good spot to end the podcast.
Sure, we brightened your day.
Ended it with the color of toilet paper.
Yeah, downers.
we aim to please on this podcast. Anyway, thanks for listening. We'll be back again in probably another week with some more content. Anything from you, Chris?
No, just don't forget to, you can go to Facebook. You can find Smart Investing Show. And if you like it there, then you'll automatically know if a new show comes up. Or you can just subscribe to this on any podcast catcher, iTunes or whatever, and then you will automatically get it uploaded onto your phone or podcast equipment.
Perfect. Thanks for giving the information, and everybody out there, thank you for listening.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.